Good morning, traders and investors. The day you've been waiting for, the Q2 preview special on PreMarketPrep.com. Joel Elconin here with Dennis Dick. I'm just going to give you the S&Ps up. We took out Friday's high. We're up 8 handles, 41, 45, 50, but we talk enough about the price action. I'm going to stop the screen share. I'm going to bring on our first guest, and that's Angie Setzer. She's the co-founder of Consus ROI, and she's going to help us forecast the moves in the commodity markets and whether they're going to have a negative or positive impact on inflation. And Angie, I say this all the time. I introduced you and the King of Corn.
You did.
I still don't, on a show that Dennis was on too several years ago, I still don't have my watch. That's a Jewish tradition. You're supposed to send somebody a watch. So I do have a really nice watch on right now. But Angie, how you doing today?
I'm great. It's just always good to know who to blame on those days when I'm like, what did I do to deserve this?
It's Joel's fault. It's always
Joel's fault.
Yeah, I've realized that. I've known Joel for, I don't even know, I feel like 50 years here now, but I guess it's only been about 24. But I've always blamed Joel for everything. So Angie, when the kids are screaming in the background and they're just annoying you and you can't get anything done, just say this is Joel's fault.
It's Joel's fault. Like it's Joel's fault. But no, for real. Thanks, Joel. And it's crazy to think about. It's been like 8 years.
Yeah. And one more thing here. You're our only guest today from Michigan, from the state of Michigan.
America's so high five.
Yep. So what do you got? What do you got for us on the inflation outlook?
Oh my God. I feel like I've been sitting here and I've been just racking my brain because I'm a grain trader. Like I'm a physical grain trader. Like that's my job. And so I tend to look at that as my sole focus. But, when you reached out last week and you're like, hey, can we talk about commodities in general? I'm like, you bet we can. And I started to dig into it and I'm like, oh my gosh, I hope he doesn't want a presentation, because really when it comes down to it, I feel like we are stuck in this sort of scenario of circular, like a snake eating itself. Like it's not even a chicken and the egg sort of thing. It's basically like, we're looking at commodity prices are influenced heavily by commodity demand, but commodity demand is going to be influenced heavily by what happens in the economy, which is going to be influenced heavily by what the Fed does, which the Fed decisions based on what commodity prices do. And so go ahead and figure that one out. Because really where we're at right now is I think we've hit a point to where the bottlenecks, a good portion of those supply chain bottlenecks, a good portion of our ability to produce, or at least meet the current level of demand is there across the board and most all of our commodities that we're trading. But what does demand look like? And what will that mean for price? And all of these things really just kind of remain left unanswered.
And I mean, this is the big question here. This is what is driving not only, and we have some traders that obviously don't look at commodities, but I mean, it's so important to be looking at commodities here right now because the inflation is the driver for all Fed action here, really. Besides, let's throw the banking crisis out, it's really been the driver here. So, I mean, if we can get ahead of the curve here and try to predict, and obviously, looking at grain here, what do you see going forward? I mean, like it's been such a difficult environment here to try to call price on everything. So we're kind of throwing you under the bus here, but are commodities going to turn around? What do you see happening here?
Well, I feel like commodities have turned around. And so now we've seen where we established what the new low would be for the time being based on the fundamentals that we're looking at. And that can be said across a whole host, whether it's crude, whether it's corn, really when it comes down to it, we pretty much set or gotten to a situation to where we know where the low prices can kind of increase or encourage that demand. We've seen that specifically in corn where, prices bottomed out from top to bottom end, 80 cents. We lost it very, very quickly. And that then encouraged China to come in and buy about 120 million bushels of corn that they hadn't had much interest in prior. And so, yeah, I mean, that's our main thing right now is I think we've pretty much established what the low end of the range will be, across the board, whether that is $68, crude or, $6 corn. But when we look ahead, specifically in agricultural commodities, we're kind of entering into a point where we're paying attention to strictly new crop, or a lot of new crop demand. And that is influenced heavily by weather, which is another thing that we have no idea. Like, we can't even control weather at the end. Like, we have no idea what Friday weather is going to look like, let alone the third Friday's weather in July. And so we just have all of these wild cards currently set up. And so for now, I think we see, a continuation of elevated prices. We've seen the speculators kind of dive out of the market for a while, especially in grains. And so that leaves them poised to kind of come back in. And so we're in a situation to where I think we see a continuation of elevated prices, but really when it comes down to it, instead of us really kind of buying dips significantly, for my customers and for anyone really in the commodity space, I think we get to where we're selling rips until we feel better about overall demand.
Okay, let's go. We've got a good question here. And, what a day to do this Q2 special with the oil shock, right? We get some good numbers on, not great numbers, but good numbers on Friday as far as the PCE. And then now we come in, we got crude trading up 6.7%. I got a question here, and it's pertaining to soybeans. How are soybeans affected by this oil price increase as far as biofuels go?
Well, we've seen, we've got soybeans up big, we've got soybean oil up big. Today, we've seen soybean oil trade to multi-month lows here recently, which is really kind of interesting because we have this big increase, or we have this perceived significant spike in renewable diesel and biodiesel demand. And so soybeans are really heavily tied to crude, currently, just the same as what corn is. And I'm looking at my quote screen just to see where everything's kind of trading today. But with the biofuels, we see this need to kind of tie ourselves to a certain extent to crude oil trades. And so you have this sort of spillover effect. We're looking at a significant increase in demand for soybeans for the use of renewable diesel. You're probably looking at right now about 400 million bushels worth of increased crush demand over the next 3 years because of that renewable diesel development and all of those things. And so soybeans are looking at a pretty significant increase in demand domestically speaking. And a lot of folks are kind of ignoring the fact that we're probably here in the US going to see a reduction in export business thanks to what we're seeing production increase wise in Brazil. But because of, the whole entire idea that commodities have found their bottom, turned around short term and are moving higher, just kind of locked arm, that's helped with soybean prices as well. Like, we basically have ripped through, the 50, 100 and 200 day moving averages on soybeans in the last 4 days. We dropped as quickly as we could and have come right back up. And we'll see that continuation of strength, I think, just simply because the outside money investors are working to come back into crude because we've seen a stabilization, in all of these outside factors. And we have this idea that the Fed is still going to back off, with talk of rate cuts by year end and things of that nature. And so in the short term, I think all of them move higher just to kind of convince the Fed that he doesn't have room to roll it back.
We're on the line with Angie Setzer. She's the co-founder of Consus ROI. Angie, first of all, have you ever been to the Corn Palace in Mitchell, South Dakota?
I have been. Yeah.
Okay, that's Doc and Dave asked that. Okay, so we got a lot of equity traders in here, right? And so let's try and pivot here towards, the commodities markets and the, in the stock market, like what companies and right now, is Calmine Foods? Are they just cranking out the eggs or what there? Let's shift our focus a little bit to the commodities markets and how that affects or positive, negatively, some stocks. This Calmine Foods, I guess they got golden eggs there. I'm going to pull that chart up.
Yeah, I feel like they definitely are one to watch. I think a lot of food producers, I think what has happened over the last couple of years, especially, is that folks are recognizing that those who produce our food are actually very great when it comes, or should be very great anyway, when it comes to managing a lot of that risk. And so really when it comes down to it, you can hedge your input costs pretty substantially in a lot of ways. And there are companies that won't or haven't, and they may feel the pinch. But when it comes down to it, the consumer is already braced for an increase in prices, and so being able to increase prices, there's some talk, of other places where it's like, all right, well, our cost structure really hasn't increased significantly, but we can go ahead and raise prices to the consumer because they're expecting it. And so I think you're going to see some continued stable margins when it comes to these food production companies. And, it makes sense to look to invest in them simply because you aren't going to see them in most instances caught significantly off guard, because it's the producer, the farmer, a lot of times, who helps kind of offset some of that margin squeeze that you can see if they mismanage their approach to hedging or their inputs.
All right. And I was just looking at the different commodities here, and I see what's wrong with wheat? Wasn't wheat supposed to
What's
what's
right
wrong
with
with
wheat
wheat?
is a better question. Wheat is kind of the canary in the coal mine. Wheat was the one that, I mean, if you go back into late 2020, wheat was the one that started to really rally when we saw Russian moves to restrict exports and some of those things. Well, now you've got a plentiful amount of wheat. Everyone thought that we weren't going to have any wheat released from, Ukraine or anything of that nature. Well, we do. And we actually have seen a lot of it piled into elevators and storage facilities throughout Europe as well. And so you've seen cash wheat prices stay exceptionally cheap around the world. They've broke down to where, you're looking at $7.50 wheat, $5 a bushel cheaper out of Russia than what we were looking at shortly after the invasion. And so the cash market right now is saying that we aren't running out of wheat. It's saying that the demand that's there is being met by the supply that's available. In fact, the supply is increasing, to a certain extent to outpace the demand as currently anticipated. And so until that changes, until you see sort of this recovery or spike in cash wheat prices around the world, I think we see wheat futures kind of same sort of story. You really want to sell any sort of aggressive rally, and then just kind of sit tight as if you're long, when the market gets to the low end of the range for now.
And what are the farmers saying out here? We're coming up near the end here of your segment. I mean, it's this is great. It's just great for the farmers. Do they think? I mean, besides the wheat farmers who are probably swapping out the corn for the wheat for the corn. What's it out there? I mean, they're the battle lines. I mean, the farmers are the most optimistic pessimists you'll ever meet, right? Like, we are very optimistic. They wouldn't plant a seed every spring if they weren't just absolutely full of optimism. But at the same time, we plant the seeds knowing it's probably likely they could fail, right? So when it comes down to it, we've been here before. We've watched cycles of commodity excitement end. And it's never fun for like the next 2 to 3 years. And so really we're the farmer and his or her advisor, we like seeing these opportunities. We're happy that the margins are there as they are. If they are, like hog producers and some of the others are already struggling. But when it comes down to it, it's a lot more stressful for, not a lot more zeros on the end of what the check is at the end of the year. So. All right. I'm going to try and do a little overlap here. We got Todd Flash Gordon here in the background. He is the founder of NewEdge Wealth and tradinganalysis.com. A little bit under the weather, in bed over the weekend, but he did not miss the Q2 preview special.
Oh my God.
Todd, we have another minute left here with Angie, and I know you follow all these different things, and she's our commodity expert. Do you want to throw her a curveball before we let her go?
Yeah. Hey guys, thanks for having me. I was just listening to the tail end, just caught the tail end of that wheat conversation. Angie, we were saying if you're long, stay long down into these range lows. I'm actually quite a big chartist. So I was just kind of watching wheat back into some support area. It was a breakout a few years ago. Seems to be holding resistance. So was that stay long, or what's the 3 to 6 month? I would say.
Yeah, 3 to 6 months for me right now. I mean, you're hard at 704. I keep looking at 7.25, 725. I'm looking at Chicago. The problem that you're going to run into in wheat that's going to be the hardest part for folks on the outside looking in to kind of make sense of is that you're going to see the Chicago versus other wheat classes spreads, that the spreads are going to trade in ways that I don't think we've seen before because of the different class structures. So it'll be possible that we could see Chicago wheat, really kind of just stay here between 675, 7.25, maybe work its way up towards 748 or so. Just kind of like I'm a backyard chartist, I say. I'm a physical grain trader, but those are the prices that I think we stay locked in. I wouldn't be the least bit surprised to, see Kansas City and Minneapolis wheat kind of drag them along due to the drought in the south, the southern plains where Kansas City wheat's grown, and the issues with planting in the north where the spring wheat is grown, the Minneapolis wheat. And so I think you're going to see Chicago wheat remain supported because of those production concerns that we have in those other two classes, but it doesn't necessarily need to see the breakout that the others might, simply because the fundamentals are different and the cash market structure is pinned to Chicago. So it'll be fun.
Wow, that's pretty.
Wow,
amazing.
you nailed that one, Andy. I
I just
mean,
said,
like,
holy
boom,
cow.
you got to go for the Tigers. You hit that one out of the park.
Cow.
Okay, Angie, we're going to let you go here. And
I appreciate it. Thank you guys for having me. I
Thanks,
always
Angie.
enjoy being on.
Okay,
Thanks,
Mr. Gordon here.
Yes.
We've been having some fun chats over. Todd joins me on the closing print every Wednesday, and we put our dukes up a few times, and he's come out on the winning end a couple times. No, I'm joking. But Todd, could you bring up that chart last week that you showed of the S&P weekly? Because Dennis is gonna love this chart, and the one where you showed the triangle.
Yeah, I feel like you remember Simon from Saturday Night Live, like we're drawing with our crayons. Like I feel like it's
Oh, I like that. I like the crayons. like those
hold on. X.X. Yeah, sorry guys. I get hit with this flu thing. My kids had it, and
You look good though. You got the flu and you look like that. You look great, Todd. I get the flu. I can't do anything.
I think it's over. It's like this 24-hour bugs.
Yeah.
It's something or other. And I was in bed for the last 14 hours.
How old are your kids, Todd?
Yeah. So I got twins who are 9 and a baby girl who's 4 now.
Oh yeah.
So
You're still
How
in the
far are
thick
you
of it.
from Toronto, Todd? Just real quick.
about 4 or 5 hours.
Because if I make it out there for the Traverse, maybe we're gonna have to get Dennis out of his cave there and meet you in Saratoga, New York, because I haven't
It's
seen
not far
Dennis
at all.
No?
No. Let's do it. I'd love to have
Okay.
you. Dennis,
All
come
right.
on.
All right, I'm in.
All right. I was all prepped and I have everything ready. And I got to relaunch one chart. Yeah, this S&P is interesting. Let me just pull this over.
Let's
Okay.
just like where we've come from here, Todd. So just before you bring up the chart, I'll just ask you the question. I mean, we have come a long ways here in a couple of weeks, and what I've been arguing is that range bound. Like we've just been in the range. If we go back to over a year ago, we were in the same spot, hovering around this 400 S&P or SPY, 4,000 on the S&P. I mean, where do you see us going? Do you see us eventually breaking out of here, or do we continue to stay range bound? What's Todd Gordon's forecast here on the S&P?
Well, Dennis, I think we're forever perpetually stuck in this range. We're never getting out of here.
Forever and ever and ever.
The S&P is going to be
25 years from now, we'll still be stuck at S&P 4,000.
S&P is going to pink sheets and we're all out of business. No, it's crazy how just how tight we are and how aggressive the bulls are on the upside in terms of their, let's say, rhetoric or the volume on social, and the same thing with the bears on the downside. I mean, boy, everyone's just kind of duking it out in here. And I think this is a classic triangle. When enough people get frustrated on the upside, bulls get frustrated on the upside, bears on the downside, enough people throw their hands in the air is when they say, all right, forget it. This market's never breaking out. And that's when it breaks. And I think we break higher. I know you're bearish, Dennis.
I'm actually neutral. I'm neutral.
Okay.
I've been neutral here for a bit. So I'm I'm in a lot of cash because I'm uncertain, but I'm more neutral.
Gotcha. Yeah, it's amazing how sideways, and it's just, I mean, nobody's talking about the fact that we're at the same price as we were as like May of 22. I mean, this is April now. We're coming up. If we make it another 4 weeks, we're 1 year inside for range. It's pretty unbelievable. I think from from a seasonality point of view, I've got a few notes prepped. Like, believe it or not, in the next 2 months, it's actually seasonality favors the value trade. I got some notes prepped for you. Energy, industrials, utilities. Like, April is a strong month, second strongest month for the stock market, but again, it's value led. We've seen a pretty good growth move. I think the NASDAQ is not as constructive right now as the S&P, even though we're showing more strength in certain pockets of the growth trade. So, I'm bullish. I still have, in the wealth management, I probably have 17% cash. I had short hedges on, some inverse ETFs in the wealth management side, and then I'm more aggressive on the research business in and out.
Yeah.
So I still have cash with you, but I did take my short ETFs off, and I'm looking for the move up. But again, I just don't want to step in front of the seasonality, and this move in energy is really interesting.
So interesting that you say the value trade and this move overnight, obviously with oil here. I mean, what's more value than these oil stocks got P's 5, 6, 7, 8, and boom, obviously OPEC talks, and all of a sudden oil listens and it's blasting off here. So we've got a number of oil stocks. I've been long Oxy from the Buffett spot at 58. But I mean, you can argue Chevron, you can argue Exxon. Things are all having huge days. I mean, it's hard to be bearish oil stocks at these valuations. Even if oil was to come back down, like some of these things are just trading with very low valuations.
It's crazy how low valuations are. And just from a crude oil point of view, like it was actually a similar looking chart to that wheat, as we were just talking about. It's a breakout from like the last 3-4 years around the 550, 600, and we moved up, but whatever, back to crude not that long ago. I mean, you got a pretty good support right around the 62 area. I was thinking crude would get down there. And then we sort of match up this low with XLE. The energy ETF has been very sideways as we've seen rotation out, as 2022 saw the rotation out of energy. XLE really just went in a triangle. And of course, I know I use Elliott Wave and Fib, which is to get my context to market position and identify patterns. And, the XLE really just went into a triangle, and we're holding the lower end of support. So I wasn't bearish crude, Dennis, and I like that. We had, on our watch list, I didn't pull the trigger. I kind of hesitated. We had Apache, we had Devon. I have Oxy as well. I've been overweight energy since the end of 21, backed up the last 6 months, went market weight to the S&P, and it's looking solid here. That's not a bearish chart right there on a crude oil.
No, and I just think we're still in this environment where, investors are obviously they've flocked in the last couple of weeks to mega cap tech, but what they did learn in 2021 is that you just can't hide in those same 5 stocks, and they came off significantly. So, I mean, if investors have learned anything, they start to go back. This value trade could come back on because the value stocks have underperformed this year. In 2023, value has definitely underperformed those. If you're not considering Apple value, and I don't, I still throw it in mega cap tech. I mean, I'm with you on the value trade. So let's move away from energy. What other value sectors do you like, or names?
Yeah. Can I jump into seasonality, or where?
Yeah, do both. Yeah, let's do it.
Okay. Let me just go back to share screen. So
before you do that, Todd, I want to throw one thing in here. What could upset the apple cart here? What inflation, the Fed? I mean, going into Q2, Q1 earnings season coming up. I mean, still trading at a high valuation. I mean, there's got to be some things that.
I mean, are we still at a high valuation though? I mean, I don't know. I think I subscribe to and I like Tom Lee's work. He makes a good point. If you strip out FANG from the valuation of the S&P, it's like trading 14.5 times forward earnings. I mean, sure, it's going to be a little bit up now. So it's exactly going back to what Dennis said. It can't be 5-6 stocks, and I can show you. I mean, small and mid cap relative to the S&P is moving. I mean, we had a really good move in the growth trade 3 months ago below the surface with communications, discretionary, and tech, but it was all like sub $75 billion market cap companies. It was all small and mediums. And then as we got the move down in rates and we started to get visibility where the Fed's going to stop raising rates, we saw large cap growth move in, and that lasted like 3 weeks. Now we're right back at small and medium cap. So I'm not really making sense here today, trying to struggle through, but it's like, So yeah, that's the point. Like, yeah, but if you take out FANG valuation and some excessive valuation, the market, I would say, is pretty reasonably valued at this point. But just looking, I just lined these up for you guys. This is cool. The ETFs, the sector spiders only go back to 99. So you're talking 24 years of data. April is the biggest month for XLE in the last 24 months. So on average, it's up 4.34%, but I think we did all of that today.
Yeah, I know. We should have done this Friday. Crap, Todd. It was there. I got to listen to the closing print more.
Yeah. And then this, I thought this was cool too. Industrials, the average is 2.97 for April, and the other big month is November. So energy, industrials, and then interestingly, consumer discretionary has their biggest month in April as well, 2.8. So that's a little bit of your growth trade. So, and then I think utilities is next. Utilities biggest month is in April. Materials biggest month is in April. So you have materials, utilities, industrials, energy, and discretionary kind of put, lumped in there. And again, this is, April, you guys know this. April and November are the two strongest months for the S&P. So this is a value trade period in here. The other thing I would throw at you, one more thing, is I'm so driven and so keen on interest rates. Every time I come on with Joel, I think he's probably tired of me talking about it. April is seasonally the weakest month for 10-year treasuries. That means on the futures, the prices. So that means seasonally, that's the biggest up month for the yield. And I can show you a couple of charts that clearly shows as US 10-year yields are moving up, that drives the rotation in value. So I think I'm kind of, if history is going to serve and rates are perhaps not going to drop, I just keep watching this 10-year yield at 3.3%.
You want to throw that up real quick? And
Sure.
yeah. And
Sure.
I'm gonna in just 1 minute here, I'm gonna be bringing on Gene Munster. We all know
Nice.
Gene Munster, managing partner at Deepwater Asset Management. But go ahead, throw your chart up there. He's
Sure.
going to reveal his forecast for mega cap tech. But let's.
I love it. Yeah. So just throwing. So what we're doing here, this is kind of fun. I'm watching these relative rotations. I really, really like this. So this is 10-year yield below, and I just do the NASDAQ in teal for good measure. And as 10-year yield moves up, watch that right chart. So growth is in red, value is in green, and rotating in is a clockwise movement. That's strength. So, as the 10-year yield is moving up, watch what's happening to value. Value is making the move up and to the right while growth is down. And now we've had the backup from rates, and you're seeing growth trying to come back in as value is rotating out. We had a little bump up, but growth said, forget it, we're going to keep going. So what I wonder is the yields, 10-year yields are pushing back around 3.3%. What happens if we do get a 3.231 10-year yield? What message does that send the market? Is that growth on? Is that good? Is that inflation under control? People are comfortable buying bonds. Inflation is reasonably anchored longer term. Or is that at some point a caution signal, a risk aversion signal? So I really, really want to see what happens to the markets if we break like 3.2 in the yields.
Todd, that's great. I got stop the screen share. I got Gene Munster in the background. We all know Gene, managing partner at Deepwater Asset Management. I don't know if he named it that after me because I'm such a swimmer. But Gene, we're going to let Todd go here in 1 minute. I know I've had you guys on before and have had some great discussions. Any questions for Todd before we let him go and get that chicken noodle soup and matzo ball soup so he feels better?
Love it.
How you doing, Gene?
Doing great. Yeah, I missed most of your comments, but
No
maybe the quick version for me is: are you feeling more optimistic about growth over the next 3 months, or more cautious?
I was just taking the guys through. This is seasonally a stronger period for materials, utilities, industrials, and actually energies. April's the strongest, and we're seeing a little bit of hesitation here on a sector rotation with discretion, comms, and technology. So I want to be. I love the action in the semis. I think semis look great. You look at Apple. I mean, Apple's up today, leading the whole market up. But I'm a little concerned, Gene, what happens if those yields drop down to the 10-year yield through 3.231? What message does that send the market? Traditionally, Gene, as you know, as yields drop, long-term inflation expectations are anchor, market rotates into growth. What happens now if we break lower in yields? What message does that send the market? I'm really interested to know what you think.
I think it goes higher. I think a lot of these growth stocks go higher, and understand the gives and the takes, some of the concern related to the macro if the yields go lower. And then, of course, I understand that dynamic. I think the dynamic that wins out is growth gets higher. And I'd say at the most basic level, I think that first derivative, that straightforward approach has played true for the last couple of years. And specifically when rates have gone down last 3 years, these growth stocks went up. And then when there start to be anticipation that rates would go higher, these stocks got hit pretty hard. And so I think it's a net positive, even with some of the dynamics. And the reason why I think it's a net positive is that just the straightforward view that if what you're going to earn in cash starts to diminish, people are going to look for performance other places. And I think one of the other pieces to this is there is going to be, and we've seen it with some of these fits and starts with these head fakes with these rallies, but there is going to be a point where these investors that have gotten hit pretty hard in tech start to believe in the rally and that it's sustainable. And I think that that will come with rates flattening out, not going up as much or even going down. And I suspect that will continue to move things higher. I'm gonna seemingly talk out of both sides of my mouth here, because I don't think we're at that bottom yet. We largely missed the rally in the first quarter in tech because of a belief that we think that a lot of these macro issues still are not embedded into the market. And so from our perspective, it's, if you're looking as a timing component here, I would still be cautious. If you're looking from the perspective that you just want to own great companies and you're okay if they go down another 20% because they've been down 80%, but you're okay if they go down another 20, then I think it's a good time to own. But to answer your question, I think that rates stabilizing, going down is good for growth.
All right, Gene, thank you. That was excellent. Todd, we're going to let you go. You feel better, okay?
Thanks, guys. Have a great
Thanks, Todd. Appreciate
great
it.
see you, boys.
Okay, Gene, once again, we have you on here. We know, you follow the mega cap technology stocks. Wow, what a rally in some of these things going into the next earnings season here. Now, to me, a lot of things are priced into perfection here for Apple. I mean, Microsoft has had a good a good run. Google's getting off the mat. Amazon still. Talk about the upcoming earnings season and the expectations with these stocks just having some really nice rallies.
So I think it's a mix. I think when you look at something like Microsoft, some of the anticipation, the excitement around AI and how that could impact their business, I think that is largely priced into shares. I don't see much upside to Microsoft. I think a company like Netflix, the recent move higher, in large part because of the better password crackdown and what the impact that can have on their earnings and revenue over the next year or so. I think that that's priced in. I think when you look at companies like Apple, I still believe that there is this continues to slowly go higher, despite higher expectations going in the quarter, in part because the numbers are going to get easier as we start to go through the year with Apple. And specifically, the March quarter should mark the bottom of their growth rate. Their business is probably going to be down about 5% year over year revenue in the March quarter. The street's looking for 3% growth in the June quarter. They don't formally give guidance, but they kind of frame it in. And based on some of the published filings that Apple has had, it sounds like that they're expecting a strong back half of the year. So just to keep going kind of rapid fire through these, Joel, in terms of Apple. What are those filings? This is about a month ago when they did their December quarter filing. They had commentary that they expect that their spending on components to be up 15% in 2023. The street's modeling for 1% hardware growth for Apple this year. Now, some of that 15% increase is likely due to some price increase, but Apple's been really good at being ruthless with their component suppliers and keeping some of those pricing down. So there's a disconnect between how Apple sees this year playing out and how I think a lot of the investors and analysts see it. I suspect Apple, they don't have obviously clear visibility on how this is all going to play out, but I would lean that they have probably a better understanding in terms of what they're hearing from customers and from some of their biggest channels like the carriers about how this year is going to play out. And then you look at some of the the chip companies like Nvidia or TSMC. Obviously, those stocks have done well relative to AI, but before this AI euphoria, those companies were talking about the back half of 23 starting to see a rebound, and usually they're a leading indicator. So that's one of the reasons why I think Apple is going to be okay here, is I think their commentary about the June quarter and the back half of the year is going to be positive. Of course, we'll likely see some form of a new product in the next few months. It may or may not be at this June's WWDC in the form of a AR wearable, but that's just a sign where they're not going to sell a lot of those, but a good sign that innovation is alive and well at Apple, and I think that investors will be upbeat about that. And so that's Apple, and the other two, if you think about Meta, is a company that we own. We like it because margins still have meaningful room to go higher. They basically their EBIT margins were in the high 30%, and then revenue started to slow, and their investment in Reality Labs, their metaverse experiment, started to ramp, and that caused margins to dip to the right around 24%, and they started to inch higher. Unfortunately, they've had those layoffs and been more aggressive with those relative to other companies. That should bode well for how analysts revise their earnings after this next Meta call. So we own this in part because of improving profitability, but also the engagement continues to remain strong. I'll pause there. I'm just going rapid fire here,
No,
Joe.
no,
I like
there's
the
a lot
rapid
of-
fire. That's good. I like the rapid fire. I want to take it back to NVIDIA. You just mentioned, obviously, just briefly here, and it's been an incredible run here for NVIDIA. The stock has more than doubled from where it was just 6 months ago here. It was never a cheap stock. It did get down to about 27 times earnings, which is about as cheap as NVIDIA has been in a long time. But now we're pushing up 55, 60 times earnings here in NVIDIA. Obviously, AI is going to be a big part. NVIDIA is going to be a big part in all this AI movement, and that's what investors are pricing in. But have we gone too far too fast?
Well, I think we probably in the near term, we probably have. I mean, this is a company that we've liked. We've owned it. We've owned it recently. But I think we start to see there's just a little bit more euphoria. I think we're talking about a $700 billion market cap at this point, and so easy to see build the narrative around why this can continue. But I think that's kind of the unique piece about what we're doing at Deepwater is around valuation, sensitivity to valuation. I think we have an ETF, ticker's LOUP. The last few years, we've done really well, especially relative to our biggest competitors that are other ETFs that do frontier tech. And those ETFs are more just focused on thematic growth, where we look for growth with a valuation piece to it. And so we bring that lens to our investing around NVIDIA, and we think at this point it's starting to get a little bit rich, at least in the near term. Longer term, company's obviously in a great position because very few companies are doing what they're doing. We're working on some bigger pieces on the topic. We'd love to come back and talk to you about those in the next few weeks. And it's related to kind of where the whole chip industry is going. And I think it's going to have an impact on companies like NVIDIA and Intel and AMD and just across the board.
What about Intel? It's had a nice move here in the last few weeks, and it's obviously been the one that's been thrown out. It's the one that's always had the cheaper valuation. Is there a catch-up trade possible here for Intel?
Yes, I think so. This is also a company that we've owned. We sold it probably 6-9 months ago on some of those kind of pretty punky earnings and just what felt like some misdirection from the company. And so I think that the theme is pretty powerful. What we have not bought back into Intel. The theme, I think the reason why there is hope here is the theme just related to onshore and related to the importance of chips. But when there is this talk about onshoring and the importance of chips, there's and Intel gets kind of brought into the conversation. There is a distinction about just, are they these higher performer, like 3 nanometer, 4 nanometer chips? Those are the kind of the reference point around the fastest chips. Typically, Intel has not done as well with those. And that's where I think a lot of the excitement is related to AI and related to, I guess, the importance of moving these chips production away from China, essentially, and Taiwan away from Taiwan, specifically to the US. And so I think that, yes, there's a thematic catch up with Intel. It intrigues us, but we're not there today.
What about AI? What about AI? I mean, Google, you thought had the big lead on it. Bard, it had the initial problem, and then it came back. I'm looking at this stock. AI has been a ripper. Where are the winners going to be in AI, and what's the timetable? Is the market getting a little bit ahead of itself with some of these issues?
So you think about AI in 3 pieces. A lot's been written about it. I'll just give you the snapshot from our perspective, is that there are kind of the core infrastructure AI companies that are building the models. And there's really 2 companies that are doing that. There's other companies, you talk about AI ripping, some of these smaller stocks. But the substance of what's going to happen around AI is going to probably come from Google first, and I think Microsoft and what OpenAI is doing. OpenAI second, and by properties of association and investment, Microsoft. So think about that as kind of the AI model layer. Tesla's in there too, kind of what they're doing, but Meta's doing AI models. But the real substance is going to be around Google and Microsoft. And then you have this other layer of companies that are kind of reinventing themselves as AI companies. Even some of the, I think those ones I would be cautious of, and that list is long. And then there's the kind of the hardware piece to it. This is an area that we're investing in. These can be some of the chips I mentioned. Just I think NVIDIA long-term is a great company around that. AMD is a company in there. That's a company that we own that plays into that. So it just essentially a lot of the building blocks around, the data centers. There's also companies that we own that do kind of management of data flow within some of these AI work centers, the hardware piece, a software piece that manages the hardware. So those are kind of the pieces that we would think of. Just a thought more broadly about AI. If you have any appetite to hear more about AI, I thought more broadly, a lot's going on. That's an understatement. Every Friday, I'm doing a tweet called This Week in AI, Friday afternoons, and just kind of recapping what's most important, because a lot is going on. And last week, kind of the big news was this open letter that signed notably by Elon Musk, that AI development should be paused for 6 months. There's 2,500 other people that signed it, but the list fell off pretty quickly after the first 80. I mean, there was one person I looked at the list that was a physician, for example, who had signed it. So, but Elon Musk signed it. That was what's important. And second is the country of Italy, I think, is banned ChatGPT for a little bit. So it's safe to say that AI is going to have a dramatic impact. I think that jumping to this conclusion that it is the beginning of the end of civilization, which some people believe, I think is probably premature. So that's kind of I would say that around the hype. Yes, there's hype. We're in the part of hype. We've seen this so many times before in tech. There's this ramp of hype, and everything that touches the metaverse or EVs or mobile or social, you pick the wave. There's the hype, and then of course there's the trough of disillusionment. We'll probably be in that in the next few months, and then the substance of this hits in the next year, 2, 5, 10 years, where we start to realize that AI is a big deal. So I'm a believer in AI is the bottom line.
Just a little bit early. All right, Gene, thanks for joining us here. Gene Munster, managing partner, Deepwater Asset Management here, giving us about as good a look at tech. And when you talk about the ups and downs and the cycles, you've been around for a long time and you've seen them. So we really appreciate you joining us here.
Thank you, Joel.
All right, we'll
Thanks,
talk
Gene.
to you. We talk to you again soon. So we are wrapping up here, and now our next segment is going to be with Cameron Dawson, Chief Investment Officer at NewEdge Wealth. She'll be focusing on the second corner.
NewEdge.
Joel,
Oh,
we're gonna fire you for that, Joel.
all right. You know, that's
Joel, he never messes that up anyway. He's usually pretty good like that.
It's that Todd Gordon guy. One of you guys has got to change the name of your company because he's NewEdge, NewEdge, and you're NewEdge. I'm sorry, Cameron. How you doing today?
I'm good, thank you. How are you guys?
Good, good. So a little bit of a rally going on here. And I talked to you on, I believe, Thursday or Friday. And I said, Cameron, what are we going to do here? What are you going to be focusing on to see, if this rally has legs or not?
Yeah. So do you want me to share some of my charts?
Yeah.
Sure. That'd be
Perfect.
fantastic.
Okay, this is going to be interesting to see how we can make this work, but let's do this. I thought in the context of the issues going on with oil that it would be good to think about what the ultimate impact of oil could be. And I feel like a boomer here because I don't know how to make it full screen, but you're
with two other boomers, so you're in the right place.
This is a
here.
blind leading the blind. But it's important to consider of how much of higher energy prices do impact the consumer. And one of the things that's interesting is that you've seen over time this steady march lower of oil intensity within the economy. And what we saw in 2022 is that as oil prices spiked, reaching about $120 a barrel, we got to a pain point where oil spending as a percentage of wages got over that 5% threshold and really did start to pinch consumers. And what's interesting is that absolutely coincides with the low in the University of Michigan Consumer Confidence Survey. So right now we're about 4% of spending. If it does march higher, this could be a source of pain for consumers. We'll have to watch. It's also important to note that that inflation expectations from consumer surveys is highly correlated to oil and gasoline prices. So that's where if we do see higher oil prices, you will see it filter into consumer sentiment. The funny thing about 2022 is that despite all the terrible sentiment we had from consumers, though, they actually kept on spending. It was this big dichotomy between soft data and hard data. We talked a lot about that. PMIs were weak, but industrial production was strong. Oil or consumer sentiment was weak, but spending was strong. So eventually, let's see if this small data closes the gap with hard data. And I think the thing that we're watching the closest here is the impact on loan growth. And so one of the interesting things, and I wrote about this a couple weeks ago, which is that when the Fed raises rates, it actually doesn't slow loan growth historically, meaning that loan growth actually accelerates when the Fed is raising rates.
Why is that?
So there's two interpretations. The first one is that banks like to lend money when they're making more money. So you're lending at higher rates, so they're a little bit easier and looser with credit. And so you do see the extension of more credit. But then it's also a chicken and an egg scenario, which is that if the Fed's raising rates, it means the economy is strong. So there's demand for loans. And so it really isn't the raising of rates that is slowing the economy until you get to a point that something happens. Maybe it's exogenous that causes banks to significantly pull back on how much lending they're willing to do. So what's interesting is that the peak in loan growth in 2008 didn't occur until March of 2008, the month that Bear Stearns happened. And so all of the weakness we saw in 2006 and 2007 brewing, and you started seeing signs that the economy was weakening, it wasn't enough to get loan growth to roll over. Similar story in the 2000s, Fed's raising rates all through the late 1990s. And it really wasn't until you started seeing issues in commercial paper markets with Enron, other accounting scandals, that loan growth plunged. And that's what led to the real downside of that recession. Same with great financial crisis. And so it really does speak to the fact that if we do have this SVB issue be the source of what causes banks to pull back on on lending, that would be what would drive the recession. It's not necessarily the Fed interest rate hikes. It's a funny way of thinking about things and it's sort of flip-flop, like I said, chicken and the egg, but it usually is loan growth accelerates until you have something that gets banks to stop lending. And is SVB that? We don't know. The thing we're watching is commercial and industrial loan growth. It's much more important than commercial real estate loan growth. Everybody's talking about commercial real estate. Yes, it could be issues on balance sheets. Watch C&I loans, though. This is far more important because this impacts the real economy a lot more. So this is probably the most important chart to watch. It's H8 data is what it's called from the Federal Reserve. You can look it up online. Comes out monthly. We'll be watching it really closely for signs that loan growth is going to slow. And if it does, what that points to is rising risk of recession, slower profit growth, falling margins, and that's where you get your earnings recession. One of the things to see this market rally so much, Strategist had a great note out today that talked about how there's been $775 billion of incremental liquidity added to the market in the first quarter of 2023. That compares to the worst month of liquidity leaving the market in the second quarter of 2022 of just about 750 billion, which means that we've added more liquidity in this first quarter than we took out in the worst quarter of 2022 when the markets were the weakest. And so no wonder stocks have gone up. No wonder growth stocks have gone up. And the question then is this 2016 or 2018 where a little bit of liquidity boosts the market higher and allows the equity market to stage a really strong sustained run like we got in 2016 and all through 2019? Or does this look more like the 2000s, 2008, 2000 to 2002, where we saw the Fed add liquidity, but it wasn't enough to offset the earnings decline? And that's where we bring it back to loan growth, because if earnings don't decline, then this market can be off to the races. If they do decline, it won't matter what the Fed is doing because you're going to see true economic weakness.
What about the other side of the coin here with, I mean, you're talking about, loan growth, but I think some of the concerns with the economy may be, on, the outstanding, payments and debt. I mean, a lot of people with variable interest rates. I mean, we could talk about the loans and the money going out, but, is there any way, or how are you gauging, the defaults, the debt that's out there ballooning at higher and higher interest rates? I know someone like JP Morgan is, put away quite a bit of reserves. Is that something that, is something that investors should be concerned about?
We do need to watch delinquency rates, but they haven't ticked up at all. So this shows you delinquency rates for commercial and industrial and commercial real estate loans, and they haven't moved higher at all yet. Now, these are famously lagging, very, very lagging indicators. The other important point to note is that consumers are less interest rate sensitive than they were in the past because of less floating rate mortgages. You had a lot more floating rate mortgages going back pre-great financial crisis. So interest rate rise, they don't have the same kind of immediate pinch. The thing that's wild, though, is that credit card rates are at a new all-time high. 19% rate is the average rate for credit cards. And credit card usage is at an all-time high. However, credit card usage as a percentage of disposable income is still below where it was pre-great financial crisis. So there's lots of puts and takes within the consumer. And the last part is to say on corporate balance sheets, after a decade plus of zero interest rate policy, what you had is a lot of companies terming out their debt. So you've seen the usage of things like commercial paper fall substantially compared to pre-great financial crisis because companies can issue 10, 30-year paper at really, really low rates that they wouldn't have been able to in the pre-QE era, which in a way makes this economy less sensitive. Even though we have higher debt levels, it makes us less sensitive to raising interest rates. Now, it does raise the question, though, about the government's balance sheet and the ability to pay for rising interest costs, which interests are expected to now be an ever increasing portion of the budget, which does effectively pinch their degrees of freedom of what they can do from a fiscal spending side of things.
That's the scary thing here, is you see the US debt clock just continuously ticking higher. And I think about higher interest rates on top of that. And I think exactly what you're saying is, how do they continue to spend at the rate they were previously spending if they're servicing this higher debt with higher interest rates?
Yeah, and it's two different questions. If you're the reserve currency, it's one thing. If you're not a reserve currency, it's a very different thing. The life of a reserve currency means that you don't live a life as much consequence as you do if you look at a country like the UK, where they had budget issues and you had a brief period of bond vigilantes coming back to really drive what they could do from a fiscal perspective. The other thing that's interesting here is that part of that liquidity injection that has happened really since October is a function of the debt ceiling. So the fact that we've been inching up towards this X state of the debt ceiling, where we would have to raise the debt limit in order to issue more bonds, the Treasury has been spending down its general account at the Fed. This is their cash balance at the Fed, so they can spend it down so they don't have to issue as many bonds. When they do that, it effectively is an addition of liquidity into the market. So a good portion of the liquidity that's been added is simply just an accounting mechanism in order to avoid going over the debt ceiling. And once we resolve the debt ceiling, that liquidity benefit to the market will start to reverse and go away.
Karen, I got one more. Oh, I'm sorry. Finish up there.
Oh, just meaning that the sources of liquidity that we've had really since the October low are the Treasury general account, the response of the Fed post SVB with the increase in the balance sheet, as well as the Japanese central bank, huge amount of bond buying in order to support yield curve control. Does that change? That's another big question.
All right, I got one more for you, Karen, from NewEdge Wealth. I got it right that time.
For NewEdge, I'm going to start burning incense and I have a book about cat astrology though, so maybe that works.
Oh, okay. My daughters would like that. So one thing that's kind of kept me, neutral or, not super bearish on the markets has been, the unemployment rate. And, it's been low. We've had these series of major layoffs by tech companies and everything is that to me, is that something that it's like being unemployment starts ticking up here and having an impact on the economy? What's your take on that?
There's a couple really important points there. The first one is you don't see consumer spending roll over until you see employment roll over. So everything we've thrown at consumers, higher debt, high inflation, it hasn't mattered because they've kept their jobs. And so if you have your job, you can keep spending, even though you might be pinched here and there, which means that we really can't make a call about the future of the state of spending and economic growth until we see the path of jobs going forward. The second point, a lot of the layoffs that were announced in the first quarter really don't come into play until the second quarter. So look at that Disney announcement. We got it a couple months ago. They just announced who was actually getting laid off. So really it's in the coming months that we're going to start seeing a lot of these big layoff announcements become a reality, which means that probably the most important weekly data we will have will be initial jobless claims, because that will give us a sense of how much of this of these layoffs are actually people who then are having trouble finding new jobs quickly. So overall, if the consumer stays healthy, it really would be a reflection of the employment market staying healthy. Now, employment's a huge lagging indicator. It will be related to commercial and industrial loan growth, meaning that if we see loan growth roll over, you could expect more softness within the consumer. But I don't know what the term is for the opposite, which is it's always darkest before the dawn. The labor market is always the tightest before it loosens, which means that the lower it is, the later cycle you are, which means that you just have nowhere to go but up. And that's, I think, the question that we'll have to continue to ask is that if we continue to stay low, how much wiggle room is there for it to improve from here? So watch layoff announcements and actually coming to fruition, but we get that initial claims data every single week. One last thing, the Fed will not have April jobs data when it makes its decision for the May meeting. They meet May 3rd and 4th. And so they will only have the March data, not only for non-farm payrolls, but also for CPI. So they will be flying blind a little bit.
All right, Cameron Dawson from NewEdge Wealth joining us here in the Q2 preview, putting the pictures with the words. Thank you very much for coming on. We'll talk to you again soon.
Thanks, guys.
Thanks, Cameron.
All right, Dennis, what are you seeing out there? Do you got your elbow there on
We've
the
rolled
sell
over.
button?
We've
Yeah.
had the 10:30 turn here, which we often see after the first hour of buy the dip came in. So we obviously had an overall dip in the S&P. The Qs were dipping as well. And then you had the buy the dippers emerge here once again. We couldn't get back to scratch on the Qs though. Microsoft actually got up, turned green briefly there, but has now rolled over as well significantly, talking about falling $2 in the last few minutes here. Tech is your weak link here today. It's not surprising. We're starting to see this inverse correlation between oil and tech. And the reason for that, obviously, oil prices going up, commodities, that's given the Fed, obviously thought process that, if the consumer is going to be a little more pinched here at the pumps, that means that, the Fed's going to look at that data and it comes back into the CPI eventually here. And that means that maybe we just can't be as loose with policy as maybe the market thinks. So
Right.
we see Microsoft roll over, Apple roll over. Apple's still trying to hold green here. I'm just looking, just go to my screen here for a second.
Yeah, great segue,
We'll
Dennis.
get to blue
here.
in just 1 second here as well.
Yep.
We've got, it's leading the charge down as tech. ARKK is now down 3% here. So we can see what the weak link is here today.
And Tesla, that news continuing on the downside.
Weighing
So
on it. It's down 12 now.
Yep. So we got Blu Putnam, managing director and chief economist of the CME Group. And Dennis, we should have been listening to this guy when he was talking to us about inflation and how it was so sticky and how it took a long time to come down. Blu, how you doing today?
I'm doing fine. Great day. Good weather.
All right. Well,
What's the weather like? What's the weather like there?
Hey, 60 degrees, a little wind. I might even go sailing this afternoon.
Can't beat that.
Oh boy. So Blu, where are we? We got the PCE number on Friday. Dennis was not that impressed with it. And we've been sharing notes and your outlook, and you're still cautious here on the inflation outlook. We got some more work to do. So take it away, Blu.
Well, I'm cautious, but I'm also, inflation's coming down. It's just not going to get to the 2% level very quickly. In fact, maybe not quickly at all. But that doesn't mean that, we're not making good progress. And I think, the Fed has to figure out at what point are we in a sufficiently restrictive stance. But one of the things that happened with the PCE inflation number was the core number is now just slightly below the federal funds rate. So that's one indication of restrictiveness. And of course, the yield curve's inverted. That's another one. So, we're at that place where, the Fed could pause if it wanted to. It may not, but it has that choice.
What do you think the banking crisis, the regional banking crisis puts, obviously the Fed has to consider more than just inflation at this point in time. And I think a lot of the market was, thinking, okay, the Fed's going to be one and done here because we can't have, regional banks failing because of increased interest rates here. Does it handcuff the Fed to a certain extent going forward? Are they cautious to raise rates? Even if inflation starts ticking higher, are they more cautious to raise rates because what they saw, at Silicon Valley Bank and Signature Bank?
Well, I think they are more cautious in the sense that the Fed was created to handle financial stability and secure the safety of the system. Of course, they failed in the 30s, and they'll always remember that. So it's definitely, takes priority. I think the Fed probably takes the view that the banking system has been stabilized, but they may also take the view, I certainly do, that we haven't seen all the after effects on the economy. Venture capital firms are not going to be able to raise their next funding round as easily, so there's going to be cost cutting and layoffs there. You have the large tech companies, which weren't affected by the banking system, but they're in let's control what we can control. This is the year of efficiency, as they say, and that means laying people off. Wall Street certainly doing a little of that. So, the labor market in the second half of the year is going to look nothing like the first half of the year. I don't mean it's going to be terrible, I just mean that, unemployment might tick up, job growth will be a little lower. And the Fed can, I think, is pondering how much to make of that. And the data is just not going to say anything right away.
Yeah, you mentioned that before about what data is the Fed going to have here before their next meeting to to make it. I mean, hopefully we don't lose any more banks between now and then. But talk about the lag in the data and the way it's coming out, and what they're going to have for. I mean, you saw the price action in the market off the last Fed meeting. What are they going to have to base their rate decision on?
When you're data dependent, it means you're looking backwards. Okay. Not a recommended way to drive your car. But at any rate, they're data dependent. And what are the data we're going to get? We're going to get unemployment, and jobs on Friday. Well, that's the snapshot taken on March 12th. Let me tell you, that tells you nothing about the impact of the banking system on the jobs market, and not even on the bigger tech layoffs, because if you get severance pay, you can't get unemployment insurance and things like that for a while. So, the jobs market isn't going to see any impact until the summer, probably the June, July, August data. And the June data doesn't come out till July. So nothing from the jobs side. Well, one thing, we do watch weekly unemployment claims, but again, they're not likely to rise until a couple of months down the road either, if they do. And then there's the inflation data. Well, the inflation data that's going to come out in mid-April is going to be for March. And again, I'm sorry, but March no longer counts.
Yeah, especially with oil. Let's look at where oil prices were in March, and all of a sudden, let's look what they are today. So this oil inflation that we just saw suddenly here over the course of the last week and especially today is not going to be in that March data.
No, and the oil price, it's been bouncing on WTI between 75 and 80 for a while. I mean, it went down lower with the banking thing and gone back. So, this is not actually new territory. If you have any kind of multi-month perspective. So I don't see that, gasoline prices, once it gets refined, are still going to be way below a year ago. So that's not going to be a huge thing for the Fed to consider, I don't think. But, the Fed, the banking system, okay, stable, but we don't know the aftershocks. Inflation, okay, it's coming down, but real slow now. And the services are sticky. And jobs are still strong. So, the Fed's not going to see the data it needs to make a decision on the May 2nd meeting.
We're on the line with Blu Putnam. He's the chief economist over at the CME Group. So, Blu, let's take this whole scenario. I mean, you said some things that are bullish and some things that are not so bullish. What does this mean for equity investors looking forward? Now, we're not looking for individual, calls and price points here, but, where do you put the percentage of a recession? Where do you put the percentage of a soft landing? I mean, you've had one heck of a rally into to the end of the quarter, but, you get an oil shock, you get different factors today. What's all this mean for equities?
All right, let's see if we can unpack this going backwards. So you said we've had this rally. Well, that rally was in 8 or 9 big tech stocks. It was not in the S&P 500 overall. So, and they were really beat up in 2022. I mean, some of those stocks that rallied were down 60-70%. By the way, if you're down 60-70%, you go up 70%, you still haven't gotten back to where you were.
That doesn't work that way.
Dennis loves that. Dennis loves it. A stock can go down 60% one day and then 50% the next day on Wall Street. I'm sorry, Blu. Go ahead.
So anyway, the rally was probably a lot of tech related and doesn't represent the market as a whole. So that's one thing. Second thing, let's go really long term. Let's think about the next 5 years, just to put it in perspective. What's going to be the big difference compared to the last 5 or 10? Well, I think it's going to be that real short-term rates are going to be positive. That means the federal funds rate is going to sit slightly above the prevailing inflation rate. And by prevailing inflation rate, I mean what the Fed looks at, the core PCE deflator. And that is at 4.6% right now, and it's going lower. It's not going to go much lower, but it's going lower. So when you're in an atmosphere of positive real interest rates, that is totally different than the stimulus you get from zero rates and
Great point.
rates being, lower than the rate of inflation. So that's a drag on equities. It doesn't mean equities can't go up. It just means they won't go up as fast as the last couple of big rallies, and they will have a continued headwind. So, the attention for equities is going to stay on what's this new environment look like. And this new environment is going to be a lot more focused on cost cutting and expense management, I should say, versus taking the opportunity to grow. Because you can, when rates are zero, you can get the funding to do all kind of new investment projects, and you can grow your business. But when rates are much higher, you've got to pay a lot more attention to expense management and slow down your investment. So, equities to me are going to go up, but it's going to be a bumpy, much slower ride than the last 3 or 4 bull markets.
So Blue, and we just got you here for another minute here. Just give us your overall thoughts here, just on where we stand, the markets, Fed policy. Just sum up everything here on. It's a tough question. I'm going to make them thrown in, but just sum everything up. With where you think we're heading here in the next 3 to 4 months.
Well, we're sitting on something that I call event risk, but what it really is the market has a view that's very, very different from the Fed's view. I mean, Fed funds futures tell you that the rate has already peaked and that they're going to be cuts in the second half of the year going down into 2024. The Fed says, no. We're not cutting. That's not our base case. We might not raise, but we're not cutting. That's not our plan, at least, base case. And so you got this dichotomy or disconnect between the markets and the Fed. That has to be resolved. That will get resolved by whether we have a recession or not. Joel asked me what my odds are. Last year, I spent the whole year telling people we might not even ever not have a recession in 2023. But now I'm looking at it with the banking system and so forth, and I've moved to 50-50, which makes me a little more of an optimist than most people. And if it is a recession, I think it's going to be pretty mild. But still, the Fed will have to cope with that. So we have to resolve this dichotomy. And so equities are going to be on edge. And I don't know if you've watched the bond market volatility, but the 2-year, which is supposed to be a pretty stable investment, has been bouncing all over the place since the banking crisis. And that just reflects the uncertainty about which way this goes. And we will not know in April. I'm pretty sure we won't know in May. And I don't really think we'll know till July or August. So we're going to sit with this uncertainty for several more months.
What about the debt ceiling, Blue?
What about the debt ceiling? If the debt ceiling turns out to be the crisis, that it doesn't get resolved, it's coming in exactly the wrong time for the markets and so forth. And so, I'm optimistic that at the very last minute, there'll be a compromise. But this year, this debt ceiling debate is more polarized than ever. And so I have no confidence in my own view on it. We're just going to wait and see, and we'll go all the way to the edge. But the timing of it coming after the banking crisis and things like that is really not good.
Okay, Blu Putnam joining us here on the Q2 preview, chief economist over there at the CME Group. Great, Blu, great input. We're looking forward to get you back on again real soon.
All right, thanks.
Thanks,
All
Blue.
right. We're continuing the leak here,
Yeah,
Dennis.
it's tech NVIDIA here, and you can just bring up a chart of NVIDIA here for a second. I mean, we've been straight down here for about 45 minutes. Not that, but we just lost 5 straight points with really no bounce at all. So this turned, and it turned very heavy here. I guess, people, and again, you look at it, got above the previous day's high, and maybe people banking that, oh yeah, here we are, we're above the yesterday's high, let's buy the breakout. Those breakout traders are getting punished here on this one, at least from an intraday perspective. But I don't think the market looks healthy here. I think that, the overall rollover now in the S&P, the thought process that higher oil prices is not good news if you're a bull in tech. You don't want to see oil start rallying. And if you think we're going into a value market, like Todd Gordon was saying a little while ago here, tech has had a pretty good run. So, some of these mega cap techs, and again, not the smaller stuff, but they're getting hit here now too. I mean, we can go to Kathy Wood, ARKK, and it is getting hit here as well. Failed at the 40 once again. But just putting in perspective, I mean, maybe we should have been talking about this more on the pre-market show or on the pre-market prep show this morning, is higher oil prices is actually really bad for tech stocks.
It really is.
Yeah.
It's bad. It's bad on the inflation front. It's bad on it's bad for the consumer. A lot of different things, but yeah, we got up to 41.57.75. Absolutely nothing up there. Looking at the S&P chart, and now this is the tricky part. Like if you are inclined to try and buy the dip in this market, I mean, we just had such a significant rally. I mean,
well, look at that bottom left chart you're showing on your screen right now. Look at the bottom left one. I mean, this is 4 days. I mean, we rallied 150 handles here. I'm looking at the bottom left, Joel. 150 handles here in 4 days. I mean, this is a significant move. So, I mean, on a pullback here, if you were just thinking want to do we love our 50% retracement, take a 50% retracement just from the move in the last 4 days. And you'll get back down there to 40-20, 40-30. It's 100 handles lower than where we are right now. So, I mean, you could, or I guess not quite there, 40-60, but you could easily drop 50 or 60 handles, and you're only giving back half of the move from the last 4 days. So I think chasing, again, we were warning about that this morning. I think you just got to be careful. If you're buying the dip, you just don't want to be too early. I do think dips will get bought, but you don't want to be too early here. And, Tesla's showing us that as well with the Tesla rollover, taking out the previous day's low now, and now, sitting very near the lows of the day. It's a concern here just because growth or tech stocks have had such a run.
Okay. All right. And Dennis, I mean, this is a little bit different for you here. You do your trades off the open, and just wanted to, just take a minute here. And I just wanted thanks. We're not near the end yet here. We're waiting for Craig Johnson to join us, but Dennis, looking at the markets, a different perspective. You changed a lot of your trading to the pre-markets and after hours. When you're seeing this kind of price action, does it make you think a little bit more? I mean, I know when we get to periods
there's
of higher
good
volatility.
intraday action right now, and with the VIX, and it's still somewhat elevated. We've come back in obviously at 19, but I still feel like, and again, I know I've brought it back to the banks, but we haven't rallied on FRC. Like, if you really believe that we are past the banking crisis and the market, I'm not talking my opinion, I'll talk the market's opinion. If the market really believed that we were getting past the regional banking crisis, FRC would not still be a $14 stock. It would be a $25 or $30 stock, and coming back and saying, this was complete mispricing. It doesn't make sense. Stock drops from 120, goes down to 11, and now we're past it and the stock's at 14. I mean, it's just not telling me. PACW is another one. It's stabilized. And, if you want to take flyers on this, it's good, but it's not good news in the fact that these things just aren't taking off. I mean, the market itself has been led by tech. The S&P has rallied substantially. The regional banks have not rallied at all. KRE is almost on its lows. This is still concerning. Bank of America not participating in the recent rally. The last 4 days, Bank of America is in the same spot it was 4 or 5 days ago. So the S&P gains 150 handles in 4 days thanks to tech, but the banks that created the problem in the first place haven't rallied at all. So when you look under the hood, if mega cap tech isn't what's going to keep us flying high here, then you got problems.
All right, the man that's going to help us figure out all these problems, Craig Johnson, Managing Director, Chief Market Technician at Piper Sandler. He is good with his fundamentals and his technicals. Craig, how you doing today?
We're doing terrific. We just got back from 2 weeks of marketing in Europe, and I got to tell you guys, the doom and gloom over there is unbelievably high at this point in time.
Really? I'm surprised at that actually over in Europe, because I look at the European markets and they are outperforming our markets. The European markets are actually doing pretty good. Is that just because of the Credit Suisse issues? Is that because of Deutsche Bank? But when you look at, the European indices, they're actually outperforming ours. I would have thought it wouldn't be so much doom and gloom over there.
You know what? I would have thought the exact same thing Dennis said if that would have been the case, but I guess people are looking around and fearing concerns about a recession. They're fearing concerns about, the bank collapse that you've seen with Credit Suisse and other things. But there's just a lot of doom and gloom and a lot of concern about jobs and employment over there at this point.
So what does this mean? How do you translate this back? Is there too much doom and gloom? And is that why we continue to climb this wall of worry? Is that everybody is just too worried?
Yeah, I think everybody is too worried. And I think there is just so much doom and gloom out here at this point in time that, you were mentioning the bank stocks and stuff at this point in time. I mean, there's sort of this view that with bank stocks and obviously Credit Suisse, getting taken out by UBS at this point in time. But when I start going through on just a pure technical basis and looking at how oversold a lot of these stocks are and these bank stocks have gotten, I mean, in terms of the KRE, we've reached some pretty unprecedented levels of being oversold on RSI and these kind of things. They're going to be due for a relief rally, Dennis, and I think a lot of people are going to be sort of surprised about. If I had to buy or sell the KRE in here, I guess I'd be looking to buy it versus sell it because things have gotten to be so extremely oversold. I mean, it's not very often that we get this so far extremely oversold in some of these ETFs.
I think I'm with you if, and again, I don't know if I'm buying the KRE necessarily, but it's like my indicator. I think when we start to actually see a rally in the KRE, that's like the green light go for stocks. And that's like why I'm somewhat cautious with this recent 150-point rally, because it has been driven by mega cap tech. It has been all multiple expansion too. And, it's been an impressive 2-week run here. But how does oil change that today? Does that change it at all? Like, I mean, oil has been sitting down here, and oil, you talk about oversold as well. Really, if you go and look at the XLE or even the Chevron and Exxon a week ago, not so much in the last couple of days, but go to 2 weeks ago when we were sitting on those March lows, that got oversold there too. How does oil change the picture with the big move in it today?
It looks like oil could go up and perhaps, it has reversed the downtrend off of the highs we had seen just a couple months ago, and it sort of has broken out of that channel. It looks like we're heading back up to perhaps retest the 200-day moving average is sort of what it looks like to me. But if I put all this stuff together, when we had the downturn in the market, everybody was looking for safety. They were buying the large cap Microsofts. They were buying the Apples. They need to put their money somewhere. For these big institutions, sitting in cash is just not an option for them. So they got to end up rotating. And I think with sort of the concern about banks coming down to a degree, the VIX coming down to a degree, you're seeing a rotation back towards some more of the sort of value, some more of the cyclical parts of the market that were working before the short-term bank crisis that popped up, Dennis. And I think you're going to get money that's probably going to rotate back toward mid-cap and more of the growth type names. And I think you're going to start to see the breadth of the market broaden out again. It's already kind of narrowed to a handful of these large cap tech stocks for now.
What sectors are you overweight then?
So we have been overweight energy. And again, it's been 70 some weeks and we've been overweight energy. Everybody wanted to throw it out the door. And now we're sort of having our day in the sun with some of these energy names right now. And we still remain overweight the industrials as we continue to see a lot of constructive charts and still inside of the industrials.
Do you have some names, like some specific names you want to jump into?
Yeah, I mean, when we go through and we look at inside of the industrials, let me just pull something up.
Yeah, let's do it.
When I go through and I look at inside of the S&P 500, and we look at things like, people have forgotten about like ITW as an example, right? Like Illinois Toolworks. It's a good fundamental, company in here, and that certainly has done well. So if you pull up the chart on your guys' end, we could take a look at that particular chart. But I guess I see, here's a stock that's gapped higher this week, and it looks like we're setting ourselves up for going back to the old highs, and you got good relative strength. But also,
what issue was that?
ITW.
Also, again, this is an oldie but a goodie. But go look at General Electric. I mean, this is
unreal.
It's unreal. It's breaking out to the highs we've seen in here. Also mentioning names in here, like perhaps take a look at a stock like Grainger, ticker GWW. Great relative strength. The trend is fantastic, and you're back above your 50 and 200-day moving averages. Absolutely nothing wrong with a stock like that.
Is this valuation, like, is this like the market looking and saying, hey, what's at a reasonable valuation here, and coming into these stocks again? Is this the value trade?
Well, it definitely is a rotation back toward value, but I think it's also just sort of a rotation back toward, some more of these cyclical names. I mean, let me back up and to say this. One of the broad discussions that I had with a lot of clients in Europe, sort of went like this. Hey, there's been 15 recessions since 1920. 10 of those 15 recessions have lasted for less than a year. And when the NBER comes out and is going to announce a recession, they usually backdate it upwards of 7.6 months, call it 8 months. By the time we're told we're in recession, we're largely out. And I think the biggest challenge for the big money pension funds out there at this point in time is that they can't miss that turn, guys, coming back the other direction. And they know that if we're going to get some sort of recession, a lot of people are already defensively positioned for that. So they want to be ready to sort of play the turn back the other way. I think is where they want to get sort of set up for. They can't afford to miss it. So I think they're going to be looking for these things. And we also know that when you're finally told you're in a recession, 14 out of 15 times the market traded higher when you were actually told that you were sort of in the recession on the announcement date. So from my perspective, I think that'd be a positive event to be told we're in a recession as we sort of look through the other side of it.
Up in January, down in February, back up in March, up and down pattern here. Talk a little bit about April seasonality from your perspective.
April seasonality is typically been among the strongest months of the year. In fact, we just called that out in our piece that just came out this morning, that April is among the strongest months of the year. We also did a study in there, which I thought was pretty cool. And again, I thank the team for pulling this together, but when we've had these strong positive Q1s, looking back to 1928, you look at what you have for Q2, and you got positivity rates around 63% for Q2. But boy, your annual return, you're higher 82% of the time when you get a positive Q1, and your average return is around 13%. And then Joel, if we take it one step further, and we look at Q1s with greater than a 5% return from 1928. Again, it's using history as a bit of a guide. Your annualized return for that year was about 17%, and you were higher 88% of the time. So again, a lot of negativity out there, but history and charts and all these other pieces suggest to us that a lot of that negativity may already be priced into a degree, and we can find a lot of good looking charts, not only in industrials, Dennis, but also just look at what you're seeing with semiconductor stocks, whether it's on semiconductor or whether you're just looking at an ETF and you're looking at the SMH as an example. That still looks like a pretty good looking stock. Don't forget about NVIDIA too.
You know what else? And just interesting, you're bringing up some, the semiconductors, but also what about old school tech here? Like Intel's had a hell of a run here. I look at Cisco trading at near a 52-week high, Oracle 52-week high. It's like the market is sifting through and finding value tech as well.
It's finding value tech, and it's, I still think for a lot of these names, there's been a lot of concentration in things like Amazon over the years. Money is coming out of that, probably going to other places. It's already working. Tesla is one that's struggling in here. Why buy this when you've got on semiconductor or some of these other ones that look still pretty darn good? And again, there's nothing wrong with the old tech side of the world either. I mean, Cisco has been definitely doing well. You mentioned Intel. Still looks like sort of a bottom fishing candidate to me, Dennis, at this point in time. But conceivably, if you think about where you run into the next sort of resistance on your Intel, it would be sort of back at about 44.
All right, give us, Craig, your overall technical setup for the S&P 500 here for, next quarter. We can go beyond that, the remainder of the year.
Yeah, so, when we're on the show the last couple of times, we talked about the hop, the drop, and the pop, a little play on the Dr. Seuss. And I don't think that we're out of the hop phase yet. I still think that we can see this market push back up toward about 4,300 on the S&P 500. And I think it's probably going to happen sooner than people think. I don't think the drop phase ultimately is going to come into play until the Fed starts to actually cut rates. And if you look at some of the world interest rate probabilities, Joel, right now, it looks like maybe your first cut could come perhaps in the July timeframe. And I would, at that point in time, think you get about a 10% correction, taking you back to about 3,800. And then I suspect that the pop phase is going to happen when we're finally told we're actually in a recession. And when we're in the recession, I think is when a lot of people are going to step up and buy this market. And there's no change to my 46.25 year-end objective. The hop,
Okay.
the drop, and the pop.
Okay. I mean, who doesn't like Dr. Seuss, right? Green Eggs and Ham, right? I used to love reading those books. So, all right, Craig, as usual, providing us great technical and fundamental information. We are going to let you go, and we'll be talking to you again real soon. Thank you. Craig
Thanks,
Johnson
gentlemen.
over there.
Have a great day.
Okay.
Thanks,
All
Craig.
right. Gonna stop the screen share here. And we were talking about across the pond, and your ears must have perked up a little bit. Michael Hewson, Chief Market Analyst at CMC Markets, joining us from across the pond. It's kind of late there. Is your day almost over? What time is it? Am I keeping you overtime?
Good afternoon, or should I say good morning, guys? Or is it afternoon there now? I sort of lose track. It's 4:30, so the markets are just closing. FTSE's up about 0.5%. DAX is down. So it's all about the OPEC production cut today, Joel. So
yeah, that's throwing us a curveball here. So that that's not good for the markets.
It's confused bond markets as well, because I think what we had initially was the US 2-year yield was up around about 4.1%. in the aftermath of obviously that announcement over the weekend. And since we got that ISM manufacturing number, bonds have done a complete reverse ferret, and yields are now negative 5 basis points and below 4%. So we're getting continued volatility in the bond market. You can sort of see it, I think, in the 2-year yield, where we're down 40 basis points on the quarter, but we've traded in 150 basis points range during that quarter.
Michael, I want to ask you, how does it feel over there? Because we just had Craig Johnson. He was talking about over in Europe, and he's like, there's so much doom and gloom. And he was talking about the doom and gloom. We see that to a certain extent here too, but I think
get
it's a
that
mix here. Are you feeling the same? How are you feeling?
I'm not. I mean, I think because there's so much doom and gloom, I'm actually slightly more constructive. I mean, if we looked at European markets at the end of last year, and you told me that the DAX would have been up 12% on the quarter, I would have taken that. I'd have ripped your right arm off. US markets been slightly more mixed. I think the fact that the DAX, or should I say the NASDAQ, is up 20% is slightly misleading, because if you take Tesla out of the equation, you take Meta out of the equation, and you take
8 stocks,
Nvidia out of the equation, all of those gains that you saw on the S&P and the NASDAQ would have disappeared. So, for me, I still think European markets can outperform US markets. When I've been on your show before, I've sort of argued that case, and thus far, FTSE 100 notwithstanding, obviously because that only finished the quarter up 2.4%. It's been pretty much in line with my expectations. I think the bigger test now is what's going to happen with rates. Obviously, the banking crisis last month has thrown a little bit of a spanner in the works, I think, when it comes to, thinking about the glide path for the Fed, the ECB, and the Bank of England. And I think in a way that's a good thing, because I think there was too much hawkishness. And I think central bankers need to be cognizant of the risks on the other side of the ledger from tightening too quickly. But I think if anyone thinks rates are going to come down between now and the end of this year, I think they're fooling themselves, because I think anything other than a sharp recession or downturn, rates are likely to stay higher for longer.
We had the regional banking crisis here in the US over the last few weeks. Was there concerns over there? I mean, obviously Credit Suisse was a big deal in Europe, but were you seeing other concerns, like people worrying about their money at any of these smaller banks?
They weren't, because I think if you look at the you could look at the UK banking sector. We had our banking crisis back in 2007, 2008. There was massive consolidation then. There was a significant increase in capital buffers. And ultimately, I think they're much better capitalized now. And ultimately, the banking sector, particularly here in the UK, is much smaller. We don't have the length and breadth of regional banks that you have in the United States. We've got the big four. We've got HSBC, we've got Lloyd's, we've got NatWest, and we've got Barclays. And that pretty much is it. So, when you take them out of the equation, they're a lot safer than they were pre-financial crisis. As for Europe, slightly different kettle of fish there, if I can use that euphemism.
Nice.
Again, the banking sector in countries like Spain and Italy, much more consolidated. I'm still a little bit concerned about how robust the sector is, but we've shown, we're not seeing any signs of significant financial stress. That's not to say that might not start to come about if the ECB does another 50 or 100 basis points. At the moment, the market doesn't believe the ECB is going to be hiking much more aggressively, irrespective of what they're telling the markets right now.
What about the US dollar? I mean, it had just that tremendous run, and you've got the pullback here. I mean, good for some US companies, bad for some other US companies. I'm looking at the dollar index futures here, getting back to par. Do you think it's just maybe just more of a stabilization instead of ripping up or ripping down? What's your outlook for the US dollar?
I'm slightly bearish on the dollar. I think we're pretty much close to the end of the Fed's rate hiking cycle. I think essentially we can probably look at maybe another 25 basis points at a pinch. I think much will depend on the payrolls data this week on Friday. But more importantly, I think the inflation numbers next week, we've got US CPI, core prices still remain fairly sticky. And I think it's going to be very difficult for the Federal Reserve to coalesce around any sort of rate cut policy between now and the end of the year while inflation remains as sticky as it is. I mean, you had Bullard on the airwaves this morning talking about, a Fed funds rate of above 5%. Now, I know he's not a voting member before all your, all your viewers scream and shout at me, but I'm certainly not seeing a shift in the narrative from Fed policymakers that they're looking or even leaning towards anything that resembles a rate cut. And certainly Powell ruled that out at the last meeting. I think the next Fed minutes should be instructive because Powell did say that they talked about the option of a rate cut. Be interested to know how in depth that is.
I think we just had.
I think
I've got our internet's okay here because you just broke up on us there, Michael. So we're just
Did it? Okay.
Yeah.
we just missed what you said at the end.
Oh, okay. What I was saying was essentially, I think the latest Fed minutes could be instructive in terms of how much detail they went into with respect to the discussion of a rate cut, because Powell at the press conference said they did discuss a rate cut. I think the wider discussion is how serious was that discussion, and I'm not convinced it was a serious discussion. I think there's potential for the fact that it may have just been, rate cut. No, we'll probably send completely the wrong message to the market about the seriousness of the banking sector, and then they moved on from that. And I think if that was the discussion, then fine.
Brexit, is that still a factor there? It's kind of in the rearview mirror here, but that was a big impact on European economies. Is that
sorry?
Is,
what did you say?
Brexit.
Brexit. Oh, don't even talk to me
Long
about
gone.
that. Long gone.
gone.
I mean, basically, what it is, it sucks the oxygen out of any reasoned debate about how the UK economy is doing, because if it's doing well, Brexit didn't matter, and if it's doing badly, it's all because of Brexit. And ultimately, I think the discussion needs to move on. It's done, it's dusted. Let's try and make the economy the best that it can be. There are concerns, I think, for me, with respect to the UK economy for Q2 and Q3, and those are over the tax rises that are kicking in this month with, various tax rises and increases in prices that we're seeing from various mobile phone providers, utility providers, electricity, water, and what have you. And we're talking 10 to 15% rises in tax and utility bills, which is likely to, I think, constrain demand as we head into Q2. The upside to that is the fact that obviously we're heading into summer, which means people won't be using anywhere near as much gas to heat their homes. So heating bills should come down quite significantly.
All
So
right.
there's a bit of an offset there.
Okay. Well, Michael giving us a cautious view there from across the pond, but not dire. I mean, we've got some bullish
No.
comments, got some bearish comments. I like your even
I
kill
thought
there,
it was more
Mike.
bullish than the last time you were on our show, actually. I thought
Well,
you were.
you know, when we talk about oil prices at $100 a barrel, I mean, I don't know what your views on this, guys, are, but I just can't buy into that narrative, because I think if oil prices do go to $100 a barrel, then we're all pretty much screwed, if I can use that expression.
Okay. All right. That's a good way to end it. Michael Hewson, Chief Market Analyst at CMC Markets,
Thank you.
joining us here for a Q2 preview. Thank you very much. I
Thank you,
appreciate
Joel.
you coming on. All right, Dennis, we've got a few minutes here to
Yeah.
banter here about the markets, which we do. We had a little break. Of course, I always like to look for the pre-market low, and we haven't. It's just dancing around unchanged here. So
But
what are you
the
seeing out there?
rotation here is nothing short of incredible today. What we have been seeing over the course of the last couple of weeks is stocks starting to move together, all stocks going up, all stocks going down. That is not the case today, and it is probably oil that has changed things. With the rise in oil prices, we'll bring it back this morning, the significant rise in oil prices, the value trade has come on something fierce here today, where the value trade was beaten up really over the course of the first few months here. It's been tech that has been outperforming, NASDAQ up 22%. But the value trade has been underperforming. That is not the case today. If you're looking at what is trading higher here, it is value stocks led by oil. Obviously, ExxonMobil, Chevron up 5%, Chevron up 4%, Occidental Petroleum, which I'm still long, up 4.2%. But what's interesting here is in tech itself. You can see that the value names in tech are the ones that are outperforming here today. So we've got NVIDIA trading in the red. We've got, Tesla, we've already talked about today with the disappointing delivery numbers, trading significantly down. Microsoft down over $3, Amazon down. ARKK, which is obviously, your growthy tech stuff, the zombie type companies, that's trading down significantly, down 3%. But look, IBM, Big Blue, which I am long, trading up here this morning. Intel is trading up here as well. I'm still on that, full disclosure. Hewlett Packard, HPQ, lower PE stock, trading higher. So if you just even Cisco holding on. So if even look just within tech, there's rotation within tech, and you can see clearly that the money is coming into the value names. If we look outside, that's the same thing. I mean, you're seeing some beaten down retailers. Macy's having a pretty good day with the upgrade, but really this market is searching for value here today, and that's what's getting bought, and that's what's holding us up.
Yeah. Now the question is it that, this is a one-day wonder because of the, 1 day, 2 day, how long does it persist? I mean, you had talked about the Johnson & Johnson, hoping that would get back to the $150.
It's starting to get some life today.
Yeah, look at that thing. I mean, just getting beat up. Procter, let me see how old Procter and Gamble's doing. That's had a nice run participating in the market.
Well, yes.
Yeah, you got your Coca-Cola,
and those are staples, and those, remember, will move opposite. So I'm not so much concerned about the rotation into them today, because obviously the market's playing a little bit of defense with tech getting beat up here today. So it blocks to the staples, which have been working. But I'm more concerned with the rotation, into oil names for tech. Like, it's basically tech versus the world here today, where you've got some of the bigger names, and the banks are down too. And that's always concerning, and keep those on your screen, because the problem with the banks, they didn't participate in the recent rally. So if they start going lower, they start making new lows, and, that doesn't look that great either. So I'm not so concerned with the rotation to Coke and Pepsi. That typically happens when we start to roll over, which we have here in the last couple of hours. What I'm more concerned is is this clear, run from run out of, some of those tech stocks that have really been working in the last few weeks. So what has been working over this course of the last even 4 days are not the stocks that are getting bought here today. It's the stocks that have been underperforming. Deere and Caterpillar are having a decent day. They're both in the green. But look at the defense stocks. Lockheed Martin trading up 10 points here right now. General Dynamics trading up, NOC, LHX, obviously, your war stocks there to a certain extent trading higher here as well. Pharmaceuticals up with the rotation. But just our point being is that we have a lot of rotation here today.
Yeah, serious rotation. So, all right, we're still dancing around unchanged here, and we got our final guest lurking in the background, and so let me stop the screen share here, and let me go to my controls. And I think everybody knows JC Parets. He's the founder of AllStarCharts, and he's going to tell us exactly what's on his mind and do a deep dive into some of his technical indicators as we are connecting to JC here. The S&P 500 index futures are traded down 3.25 points.
There he is. There he is.
I said the S&P.
I still love the Mike Tyson's punch out in the back though. Like whenever JC comes on, it makes me smile because I loved that game as a kid. That would be the best game, isn't it, JC?
I mean, you know, I had a friend who was able to beat it with one hand, like his right hand, and like was working on being able to beat it with his left hand.
No, that's impressive. Is it autographed by Mike Tyson in the back? Who's autographed that thing?
It is Mike Tyson.
Oh my God, that thing is awesome. That is just awesome. I love that.
I know. I wanted in a charity. So I wanted in like a silent auction, a charity event a long time ago when I was living in the city, and I was giving a presentation. I moved into a new office, and I was giving a presentation and with financial advisors. And you know how financial advisors, like, they always like, oh, everybody has a plan until you get punched in the mouth, right? And they quote Mike Tyson. So I was making fun of them at a financial advisor conference, and people thought it was funny, so I just left it up there.
That's awesome.
No, we like it. All right, JC, we've had some bulls and some bears and some super bulls and super bears, tepid bulls and tepid bears. You like to state your case. I know you like to do it with your technical indicators. I don't know if you want to give a little bit narrative first before you go to the charts, but we've noticed your bullish stance here during the pullbacks. Where are we at in JC technical land?
Well, I mean, listen, you know, I think in bull markets, historically, stock prices go up, right? That's like a, you know, very, you know, logical, just we can all agree. Like Karma Bears will also agree that in bull market, stocks go up, right? Like there's no disagreement there.
Yeah.
But when we try to identify, and by the way, not just stocks go up, but more and more stocks are going up. More sectors are participating to the upside. More countries around the world are making new highs, right? Like it's like a common theme. That's what a bull market is, right? No one's going to disagree. It has nothing to do with this 20%, this, you know, we're off 20% off the lows. It's a bull market. Well, in some of these volatile markets, you're getting that in a couple of days. So that's a new bull market.
Right.
No. So those are just arbitrary numbers. So it's really a function of the environment, right? You and I were talking, Dennis, I think over the weekend, messing around whether it's a bull market or bear market. You're like, oh, but it's not a bull market in financials. Right. In other words, yeah, financials are underperforming dramatically, by the way, particularly in America. But that doesn't change the fact that the majority of stocks are still going up. The majority of stocks have been in strong uptrends for over 3 quarters at this point. Remember, and I'll show you guys if you want, I mean, it's all free public data, but the new 52-week lows list peaked in June of last year. And since then, what have we been seeing? Fewer stocks making new lows, fewer sectors going down, more sectors going up, more stocks going up, more countries around the world participating to the upside. That's what we've seen since last June. So you can argue that that's a bear market if you want, but I've studied every bull and bear market in history. I've participated in a bunch of them at this point. And the bottom line is it's been easier to make money from the long side. It's been easier to make money buying stocks. Your time has been better spent looking for stocks to buy versus looking for stocks to sell. Yes. Have financials, a bunch of them fallen apart? No doubt. Could this be some sort of systemic, you know, end of the world scenario that the financials are driving to the downside? Absolutely. There's no evidence of that whatsoever, right? Like that might happen, like starting today or starting tomorrow or something like that. But we have seen no systemic implications at all of some of these bank failures or recessions or, you know, Trump indictments or whatever the narrative is for the day, all of the above. I don't know. Something about OPEC yesterday, everyone's making a big to-do. I don't care and I can't keep up with it. But if that's what that means to you, like, oh, stocks are up, that means the Fed is done tightening or whatever. If that's what's important to you, then great. But I don't know what that has to do with the stock market. Like, if that's how you're interpreting what the S&P 500 is doing, like, knock yourself out. But what does that have to do with stocks going up? You guys just now were mentioning healthcare. Healthcare has been a laggard. Healthcare has been underperforming. Guess what? It's absolutely ripping. It looks great, right? A lot of these healthcare names, these large cap healthcare names, look at medical equipment stocks, Merck off these lows. You could buy Merck all day here. Nice risk versus reward. I'll tell you right now, buying Merck all day against 100, 104. If we're above that, you stay long all day. These are massive bases. So I think the fact that healthcare is now picking up, and then what happened in the first quarter of this year? Technology-led, consumer discretionary, communications, the worst freaking places over the last couple of years, right? And then even though the bull market started last June, technology and growth had yet to participate. They certainly made up for that in Q1, right? So sector rotation is the lifeblood of a bull market, right? That is
it's also the lifeblood of a bear market too. And I'm not saying we're in a bear market, but what I would argue with you, and I'm looking at the S&P, and I've been arguing neutral sideways market. And I look at the last year, and even you can go to June and say, yeah, we're up from June, but you can also go to July and we're down from July. So because the S&P went up to 420 just in the end of July, early August, where we peaked, I kind of feel like we've just been chopping around, really going nowhere. And that's why I've been arguing that I'm taking little gains where I'm taking 5, 6, 7% gains here, 5, 6, 7% gains there, as opposed to just positioning myself fully long or fully short. I'm just going with the neutral, where I think we continue to chop around. I think we're more in a trading range in the S&P as opposed to, a rip-roaring bull market.
I couldn't agree more. Look, are you looking at the S&P 500?
That's what we're looking at, yeah.
Yeah, you're absolutely right, right? And this isn't brain surgery. Like, it's just common sense. Like, look at this mess. Chop, 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 chop. Everything Dennis is saying, you're absolutely, I couldn't agree more. In fact, we've been saying the exact same thing, right? So mean reversion strategies, selling the wings in the options market, those things have been working very, very well. But that doesn't change the fact that underneath the surface, more stocks are going up, more sectors are going up and up and up.
It depends, though. Like, obviously in the S&P, that's not the case, or we wouldn't be in the same spot. If more stocks were going up, we would be higher than we are now. Well, now, I know in Europe, and I completely agree with you, Europe has outperformed. Europe looks good. Qs look good in the last few months for sure. So it just kind of depends where you're looking.
You nailed it with Europe, making new 52-week highs as we speak. Countries around the world, like the United Kingdom, like France, Denmark, all making new all-time highs. Spain, Italy, all these names making new 52-week highs. Ton of strength in Europe and also in Japan for sure. But so the S&P 500 is one index in one country. Granted, it might be the most popular index. You can even argue that it's the most important index. I don't. I think it's the Dow Jones Industrial Average, but nevertheless, they move together. So we're all in agreement here that these, one's price weighted, one's only 30 stocks. Yeah, the other one's cap weighted and 500 stocks. And guess what? They move together, right? You could love it or hate it. I mean, that's just the bottom line. And the fact of the matter is, the S&P 500 has been a laggard because of all of that tech exposure got dragged down so much that technology and growth, you can see the Qs here, 20% this quarter, monster number, that just started, right? A lot of the NASDAQ stocks and a lot of these major components were still struggling into the fourth quarter. Yeah. This rotation into technology just got going. And in the S&P 500, you've got a ton of technology exposure, Dennis, and you got a ton of growth exposure. And those things just started coming around, while in other countries around the world, they've had more exposure to materials, to industrial stocks, to energy stocks. And because of that, those have already been participating for 9 months now. That's not anything new. So all of these other countries have had a head start on the United States simply because of its exposure and the types of stocks that are in those countries, which is very different than what drives the S&P 500, right? So it's more of a, it's more of a construction. It's the components that are in the S&P 500 is what dragged it down until recently. Now, this quarter was the opposite. Look at the Qs. The Qs are the monster outperformer.
Yeah.
Why? Because you got that ripper mean reversion and all the stuff that was struggling for so long. So when you talk about, you mentioned before, sector rotation is also the lifeblood of a bear market. 100%. In bear markets, the last leaders hatch down to the laggards, right? That keeps happening. You get, oh my God, look at the relative strength in this particular sector while all the other stuff is getting crushed, and then that one gets hit too, right? for sure. But
so
that's
JC,
not
we
what's-
can and we
that's
can
not what's
debate
happening.
what we've been in or what, but the bigger question is going to be going forward is where are we heading? You know, where are we going is more of the question. Like obviously today we've had a pretty good rally here in Europe. We've had a decent rally in the last few weeks in the S&P. What do you see in the second quarter? What do you see coming up?
I mean, listen, the trend is your friend with benefits. And since last summer, stocks have been going up, right? Fewer and fewer stocks going down, more and more going up. Sectors participating to the upside. The laggards are catching up to the leaders. We just discussed with technology, communications, and discretionary. From a seasonality standpoint, this is the most bullish time of the entire 4-year presidential cycle. Pre-election years, we've never had a recession start in a pre-election year. Everybody keeps telling me that we're in one or we're going in one. Stocks keep going up. So I'm going to trust price. I don't trust people, right? I trust the bond market and I trust dogs, right? That's who we want to trust here.
Dogs.
Humans, yeah, dogs. You got to dogs are never going to bullshit you. You know what I mean? So this is a very bullish. So here we're looking at a seasonal composite for the year. So we're looking at every year since 1950 for the S&P 500. We're looking at every pre-election year and then every third year of every decade for that decennial cycle and equally weighting it. And this is what it looks like. It goes from the lower left to the upper right. When you look at the Dow Jones Industrial Average, which is the most important index in the world, people ask, oh, what the market do? Dow's up 200, Dow's up 300.
Yeah,
yes, we know. People like to make fun of people who price it in points. But if you've been doing this long enough, you know what 300 points on the Dow means. Not what it used to be. It's not what it will be. But you basically, you know the math. You know what the market looks like. All right. So we don't have to be like, oh, Mr. Cool, like, oh, S&P. The Dow Jones Industrial Average, look at the advanced decline line, pushing up against new all-time highs. Right? So that's what I see. You know, the way I learned it was don't fight Papa Dow. Like I could hear Ralph Acampora yelling at me, JC, don't fight Papa Dow. And you know what I used to do when I was younger? I would fight Papa Dow. I'm like, nope, it's only 30 stocks. The S&P is 500. That's more important. Nope, price weighted is stupid. You look at cap weighted indexes. Like, all right, bro. I learned the hard way that the Dow Jones Industrial Average is the most important index in the world. Trust me, right? I've gotten this drilled into my head. You do not fight Papa Dow, right? And a great way to not fight Papa Dow is look at, some of the components that are inside of it. Apple's biggest stock in the world. Does this look like a downtrend to you, Joel? Dennis?
What would change your mind, JC? What as far as price points? Are there any levels on the index where you would change your bullish thesis or an indicator?
Well, I don't necessarily. Well, I think that we are going to break out to the upside because by far and away, there's overwhelming evidence that we will. We haven't yet. The S&P 500 has yet to break out. But what does the S&P 500 not breaking out have anything to do with buying McDonald's that's breaking out of this base to new all-time highs? What does one have anything to do with the other, right? What does, looking at, I had a couple of charts here for you. What does buying Boeing above 200? What does that have anything to do with the S&P 500? Weren't you guys just talking about how
I didn't ask you about the
defense
S&P
stocks are doing
500.
great?
I asked you what would change your mind in the Dow. I didn't ask you about the S&P 500. I asked you about the Dow.
Well, these are all Dow components for one, right?
So what would change your overall theme? I mean, your thesis, is there a level? Do you have an upside, projection?
Well, for the Dow Jones
35,000, 40,000, 50,000.
So the Dow Jones Industrial Average, like the S&P 500, is still in a sideways range also, right? It's still in a sideways range. They're in similar neutral ranges. So
yeah.
The way
this was my argument. It all looks neutral to me. I mean, obviously I look at Europe and I see bullish, but in the US, I see kind of neutral. I see the Qs have come up, but I still see kind of neutral.
Right, but it's a market of stocks and not just these indexes. So my point is, Joel, while I might still be neutral, the S&P and the Dow, like we've been for quarters now, because they've been in a neutral range. Like Dennis, the way you described it is absolutely perfect. But if you're trading the averages, the way I learned it is, you want to get average returns, right? Trade the averages. For me, that's very difficult. Unless what you said, like, yeah, there are strategies where you're selling the wings and you're sort of buying dips and selling rips. And like, there's those strategies if you want to trade the indexes themselves. But there have been a lot more opportunities at the sector level and at the stock level. And that's just math.
I agree with you.
Way better off in individual stocks and sectors than you have been in indexes, as you just described. The S&P's gone nowhere. So, Joel, to answer your question, what's going to change my mind that we we don't break out higher, that we don't break out higher. We still haven't, right? It's just my suspicion is it's coming. 34,500 is a big one for the Dow Jones Industrial Average. The number for the S&P 500 is about 4,200. If we're above those levels, it's hard. I can't argue that we're not breaking out. Number one. Number
it's
two,
a really good
momentum.
argument too. I mean, it's
Right?
a really good argument. You know, even when you go to Europe, it makes me think like when you're seeing the breakouts over here, and Europe was, having their problems, serious problems a little while ago. So as you see, even, the Asian markets, you've seen other markets start to pick it up here. It does feel like, maybe we've been lagging for a little bit and maybe we do break out.
And not to mention that Europe put up a 16 spot in Q1 after a 25% return in Q4. This is not anything new, right?
Yeah.
So it's not like, oh my God, Europe is outperforming out of nowhere. Are you kidding me? This is old news.
Yeah.
I keep being promised a crisis. I'm not seeing any crisis. What crisis? The only crisis is in the portfolios of the perma bears. What I'm seeing is price shaking off bad news, right? Like you guys have been doing this. You guys have been doing this longer than me. When you're seeing prices going up on bad news, right? It's priced in. When you're in long-term uptrends and you're getting good news and stocks are not going up, the trend is exhausted. Like you guys know, you don't have to tell me. Like you guys know this. We've seen it before. And how are stocks reacting to the bad news? Seems to be acting pretty damn well.
That's one thing. Yep. And we'll see. We got earnings season just around the corner. So we'll see what's in store for that. JC, great levels, great presentation. Love your thesis. Love those charts there. Thanks for coming on today to wrap things up. And we will be speaking to you again real soon.
Joel, listen, watch for the new lows list, the 21-day lows, 63-day lows, right? 1 month, 3 month lows, 6 month lows. If you start to see those expand, right? If you start to see breadth deterioration to the downside, we could be rolling over, but we're not seeing that at all. So that's what I would be looking for.
Yeah, we're too early to be going
That's
bearish.
what we got. So, okay.
All right, guys.
JC,
Thanks,
thank you. Yeah, thank you
Adios.
very much. Okay. We're up against the clock here at noon, and S&Ps are, had a little dip, but still holding in here unchanged on the session. We wanted to do this for you guys today. We want to get your feedback for more things like this. What would you guys like to see from us more during the day or after hours? Obviously, you have the pre-market. So please send your feedback to info@premarketprep.com, and we'll take all those suggestions into consideration here moving into summertime. Triple D, a lot of great opinions here and everything, and a pretty tame market. Just any closing thoughts?
Chop. I think it's just what we're in. I think we're more in a choppy environment, and what my consensus is that the previous, and obviously we've had really good rally. To JC's point, he's making some fantastic points. I mean, Europe has just been taking off, and a lot of people were underweight Europe, and I think there's a little bit of a catch-up trade happening here too, because European indices have underperformed our indices for a long time. So I mean, I look here and, can look at the Dow Jones, you can look at the S&P, can look at the IWM, and it's more just chop right now. We're just not, and again, maybe we look at the advanced decline lines, we can look at different things and, maybe find a different picture. But overall, what I really feel has been working for the last year and what has worked for me, and I'm going to be posting my returns for the last year later this afternoon, because I just, on April the 1st, it marks 1 year since I've left Bright Trading, so I can post my 1 year. Yeah, I know, it's been 1 year. It's crazy. Yeah. So I can post my 1 year returns, since I've left Bright Trading in my trading account. But the way I've been producing those returns, and they were pretty good. Last month, I think it was 6.6%. So I didn't quite get to the 7 on my overall account. We're talking my trading account. But the way I've been producing those returns in the last year, really just playing the chop. It's really just fading moves. Contrarian market is what we've really been in over the last year. And we may go into this bull momentum market, and we'll have to adjust. But in the US, we've still just been in this neutral market where chop has been working. On the S&P, it's been working. On the Dow Jones Industrial Average, it's been working. And that makes up, in the IWM, it's absolutely, been more of a bearish market there. So, I mean, you kind of went through the big three in the US to give us a picture that really in the US, whether we've been a bull market or bear market, we've really been in a neutral market. So does that continue? I think it can. I think you can still see European indices perhaps outperform. They've been outperforming. There is the potential for a catch-up trade there. So I think we just need to just keep playing, from a contrarian perspective here, because that's what's been working. I know people were coming on the show a month and a half ago and, January, rah, bullish. And then I watched the markets fall 10% in February. So, I mean, we've just rallied now almost 10% from the March lows in the second week. So if I'm playing range bound, I'm a net seller of stocks up here, kind of booking the profits from maybe some of the stuff that I've already just taken. So contrarian has been working. We will go to a momentum market here again. It will happen in all likelihood. We will resolve ourselves to the upside unless you think the meteor is crashing, the end of the world's coming. Markets in the long run tend to drift higher. They tend to go higher. So once we get past, the inflation concerns, once we get past, the regional bank concerns, once we get past all of that, eventually we probably resolve ourselves higher. I just don't know if I see us rip roaring and rallying next week though.
Yeah, I think for what I'm going to be watching for, next couple days or, this week is, that the tech led us here. And for a while we were saying, oh man, just if the tech could just stop going down, right? Or stabilize, the other parts of the market, could bring us up. Now you've had the big rally in tech. Now you have the big earnings season coming up. If the stocks, whatever the reports are, can maintain this level. And I don't think that, Apple has to tack on another 15 points, or Microsoft another 30 or 40 points, but just could prove that it can consolidate at these levels and hold these levels and not give them back. Then that's what I'll be looking for. We had a good close of the quarter, obviously be hawking that 41.37.75 close from yesterday. The numbers are set up for a bullish week, based on the price action we had. The daily resistance that we have, there's not much in there, basis the S&P, until you get closer to 4,200. I just don't feel it's going to be the same route that we had last week, the rip and route. I think it's going to be a little bit tougher. So, all right, folks, it's a little bit overtime here. We've kept you here for a long time. Please send your feedback to info@premarketprep.com. Dennis, thanks for joining me here for this extended
fantastic
session.
lineup of guests. Thanks for putting all this together, Joel. Everything went well. Again, thanks to everyone who's joined us for the last couple of hours here in the chat. We love your comments. The chat is what makes these shows, gives us so many different direction ideas. I mean, I've learned so much even from the Pre-Market Prep Show chat on Benzinga. We've learned so much over the years from just our chat. It's hard to fight this battle alone. I mean, this is the biggest issue that I think traders have is, you sit in your office, you're sitting alone, and, you're looking at media, you're trying to figure it all out. That's why when we can get a community of traders like we have at Benzinga, like we have at Pre-Market Prep, it helps so much. It helps to clarify even my own thoughts, and it gives me different perspectives. I mean, bringing JC on, who's in the full bull camp here, he's makes some fantastic points here. So you've got to be open to all those perspectives, and you got to be able to trade what you see and not always what you think. And what I think is, I don't get the valuations on certain stocks. I don't get, that some of these regional banks, are still, holding up as well as they were with the concerns. But at the same time, I've got to respect that. Hey, the market's telling me something else over the course of the last couple of weeks, and it's telling me that the rotation, which JC was making a great point, the rotation continues to bring us higher here. So just today, even today, where you get tech weak, Tesla very weak, well, look what picks up the slack. Value comes to the rescue here today, and that's holding us up. So the lifeblood of a bull market is definitely rotation, and that's what we're seeing here today. The S&P is holding up fairly well despite some very big weakness from some of the very largest components, but that's rotation keeping us up.
Yeah, we'll keep an eye on that for you. Send your comments to info@premarketprep.com. We're signing out. I'll be back at 3:30 with the closing print. So everyone, have a good day. Once again, thanks for joining us.